Just imagine this. After suffering what many called its most punishing on decline in over a decade, gold suddenly reignites with a surge that catches the entire market off guard. One moment the headlines declare defeat, and the next, prices climb more than 2% in a single week, reclaiming territory above $4,100 an ounce. This dramatic reversal is not just another fleeting move in the precious metals arena. It signals deeper forces at work in global finance, where policy whispers from central banks can reshape investor confidence overnight. Today, we dive deep into the shifting currents of the gold and silver markets, exploring the catalysts behind this turnaround, the long-term implications for monetary policy, and the hidden opportunities that could reward patient participants far beyond spot prices alone. The recent quarter delivered a stark reminder of how volatile these assets can be. Gold posted losses approaching 13%, marking its weakest 3-month stretch in more than 13 years. Pessimists were quick to pen the eulogies, pointing to strengthening economic data, shifting rate expectations, and broader risk appetite that seemed to sideline traditional safe havens. Yet those declarations proved premature. Almost as soon as the ink dried on those bearish reports, a few carefully chosen remarks from monetary authorities altered the narrative entirely. Markets reacted with renewed vigor, pushing gold higher and lifting related assets in tandem. Platinum and palladium joined the advance, underscoring a broader metals resurgence that extended beyond the yellow metal. What makes this episode particularly instructive is the way it echoes patterns etched into financial history. Decades ago, when inflation pressures mounted across major economies, policymakers responded with aggressive rate hikes intended to restore stability. Those actions succeeded in cooling price surges temporarily, yet they carried painful short-term consequences for various economic sectors. Eventually, political considerations prompted a pivot, with rates eased and signals sent that immediate priorities outweighed long-term currency defense. The result was a profound loss of faith among savers and investors worldwide in the steadfastness of the dollar's value. Gold, which had traded around $200 an ounce prior to the tightening cycle, plunged roughly 50% over 9 months. Mining equities suffered even steeper declines. Many dedicated followers of the metal, comfortable at higher levels, lost conviction at the lows and exited precisely when the foundation for a major recovery was being laid. That subsequent advance proved transformative, rewarding those who maintained perspective amid the turbulence. Fast forward to the present environment, and familiar dynamics appear to be resurfacing. Central banks face the perennial challenge of balancing growth objectives against inflation risks. Recent communications suggest a willingness to prioritize flexibility, potentially easing the path for accommodative measures if conditions warrant. Such rhetoric, even when subtle, can profoundly influence asset allocation. For gold, which thrives in environments of monetary uncertainty and diminished confidence in FOT reserves, these shifts act as powerful tailwinds. Investors seeking protection against currency debasement or geopolitical tensions find renewed appeal in the metal's timeless attributes: scarcity, portability, and universal recognition as a store of value. Silver, often overshadowed yet intimately connected, mirrors and at times amplifies these movements. As both a monetary metal and an industrial input critical for solar technology, electronics, and medical applications, silver benefits from dual demand drivers. When monetary concerns dominate, it follows gold's lead. When economic optimism prevails, industrial needs provide additional support. The recent synchronized uptick across the complex highlights how interconnected these markets remain. Participants monitoring the ratio between gold and silver prices often gain insights into relative strength and potential inflection points. Currently, the interplay suggests a market recalibrating after the recent pressures, with silver demonstrating resilience alongside its counterpart. Delving further into the mechanics, consider the role of real interest rates. When adjusted for inflation, these rates dictate the opportunity cost of holding non-yielding assets like gold. Elevated real rates tend to pressure prices downward by making yield-bearing alternatives more attractive. Conversely, prospects of declining real rates, whether through nominal cuts or persistent inflation, enhance gold's luster. The latest policy indications appear to tilt toward the latter scenario, fostering an environment where capital flows back toward hard assets. This transition rarely occurs in isolation. Broader market sentiment, currency fluctuations, and central bank reserve management all contribute to the mosaic. Nations diversifying away from traditional reserve currencies have steadily increased gold holdings, providing structural demand that cushions downturns and accelerates recoveries. Beyond the metals themselves lie the companies that extract and produce them. Mining operations represent leveraged exposure to price movements, capable of delivering outsized returns during favorable cycles, yet facing amplified risks during contractions. Operational efficiencies, reserve quality, jurisdictional stability, and management expertise all factor into individual performance. Historically, the sector has lagged spot prices in certain phases due to rising costs, project delays, or equity market correlations. Yet, astute observers recognize periods when valuations decouple from underlying fundamentals, creating compelling entry points. Current dynamics may exemplify such a window, where producers demonstrate robust balance sheets and disciplined capital allocation despite recent headwinds. Cash flow generation at prevailing price levels supports dividends, exploration, and debt reduction, positioning well-run entities for substantial upside as sentiment improves. One key indicator that often commands attention transcends the daily fluctuations in spot prices, the behavior of physical markets and inventory levels. Sustained withdrawals from exchange inventories, robust over-the-counter demand, and elevated premiums in certain regions can convey conviction that paper trading fails to capture. When fabricators, jewelers, and institutional buyers compete for tangible supply, it reinforces scarcity narratives and can presage sustained rallies. Monitoring these flows alongside futures positioning and derivatives activity offers a more nuanced view than headline prices alone. In the current climate, such signals suggest underlying strength that could sustain momentum even amid macroeconomic crosscurrents. Looking ahead, the interplay between fiscal policy and monetary accommodation remains pivotal. Expansive government spending combined with elevated debt burdens raises questions about long-term sustainability. Markets increasingly scrutinize whether authorities will tolerate higher inflation as a means to erode real obligations or pursue stricter austerity that might slow growth. Gold serves as a barometer for these debates, rising when confidence erodes in the ability to navigate these tensions without compromising currency integrity. Silver, with its broader applications, adds layers of complexity, but ultimately aligns with similar macro themes. Investors incorporating these metals into diversified portfolios often cite their low correlation with traditional equities and bonds, enhancing risk-adjusted returns over extended horizons. The recent rebound also invites reflection on behavioral aspects of investing. Fear and greed drive short-term volatility, prompting capitulation at inopportune moments and FOMO-driven entries at peaks. Those who weathered the latest downturn without abandoning core convictions now find themselves better positioned to capture the recovery. Discipline, thorough research, and a focus on fundamentals separate successful participants from those swayed by transient narratives. In precious metals, where cycles can span years or even decades, patience emerges as a decisive advantage. Historical precedents demonstrate that pronounced drawdowns frequently precede extended advances, rewarding strategic accumulation during periods of pessimism. Examining supply-side considerations further illuminates the outlook. Mining output faces inherent constraints, declining ore grades in mature districts, permitting challenges, and substantial capital requirements for new projects. Exploration success rates remain modest, and geopolitical risks in key producing regions add premiums to future supply projections. These factors create a structural backdrop supportive of higher prices over time, particularly as demand from technology, renewable energy, and reserve accumulations accelerates. Silver's industrial consumption, projected to grow with global electrification and green initiatives, complements these dynamics, potentially tightening markets more rapidly than many anticipate. Central to the narrative remains the evolving stance of monetary policymakers. Indications of pragmatism in addressing economic slowdown risks have alleviated some pressure on risk assets while simultaneously bolstering gold's appeal as an alternative. Should subsequent data reinforce this posture, additional stimulus measures or balance sheet adjustments could amplify the effect. Quantitative easing programs historically correlated with strong performance in hard assets as increased liquidity seeks outlets beyond traditional channels. While outcomes depend on numerous variables, the precedent suggests meaningful potential for continued strength in the precious metals complex. For those considering exposure through equities, several principles merit emphasis. Focus on entities with low all-in sustaining costs, strong free cash flow margins, and prudent hedging strategies that preserve upside participation. Geographic diversification mitigates country-specific risks, while attention to environmental, social, and governance practices increasingly influences capital availability. Junior explorers offer higher risk-reward profiles for those with appropriate tolerance, contingent on rigorous due diligence regarding project economics and management track records. Across the spectrum, The sector's leverage to gold prices means that even modest sustained gains in the metal can translate into significant equity appreciation. Market psychology also plays a crucial role. Sentiment indicators ranging from retail positioning surveys to professional manager allocations often reach extremes before major turning points. The abrupt shift from widespread bearishness to renewed optimism following policy signals exemplifies this phenomenon. Maintaining objectivity amid such swings enables capturing value when others retreat. Educational resources, data transparency from industry associations, and engagement with experienced market observers all contribute to informed decision-making in this specialized domain. As we navigate these developments, broader global context cannot be ignored. Rising multipolarity, trade realignments, and technological disruptions reshape economic landscapes. Gold and silver, with their enduring roles across civilizations, provide continuity and optionality in uncertain times. Whether as portfolio insurance, tactical trades, or long-term stores of value, they occupy a unique position. The recent quarter's trials and subsequent resurgence serve as a vivid illustration of resilience and the rewards of perspective. Looking toward upcoming gatherings and industry forums, opportunities abound for deeper engagement. Events bringing together producers, investors, and analysts facilitate knowledge exchange and networking that sharpens strategic approaches. Such venues often surface emerging trends, technological innovations in extraction and processing, and evolving investor preferences. Participation, whether in person or through virtual formats, enriches understanding and potentially uncovers specific opportunities aligned with individual objectives. In synthesizing these threads, the gold and silver markets stand at a compelling juncture. The latest rebound validates the metal's enduring relevance amid policy flux and macroeconomic evolution. While short-term volatility persists, structural drivers point toward sustained interest. Investors who approach with diligence, diversification, and a long-term horizon position themselves to navigate the cycles effectively. The interplay of monetary signals, physical demand, mining fundamentals, and sentiment creates a rich tapestry ripe for exploration. As conditions continue developing, staying attuned to these dynamics will prove essential for capitalizing on the opportunities inherent in this timeless asset class. The path forward invites careful consideration of risk management alongside growth potential. Position sizing, regular portfolio reviews, and integration with broader financial planning help mitigate downsides while preserving participation in upside scenarios. Educational commitment, whether through market reports, technical analysis, or fundamental research, empowers more confident navigation. Ultimately, precious metals reward those who respect their unique characteristics and historical lessons. The recent turnaround, emerging from apparent weakness, reaffirms that profound opportunities often arise precisely when consensus turns most negative. By maintaining focus on enduring principles rather than fleeting headlines, participants can harness the potential that lies within these vital markets.